Welcome to the Deep Dive, your ultimate shortcut to being well-informed. Today, we're doing a deep dive into Dragonfly Energy's second quarter 2025 earnings call. And this wasn't just another quarterly report. It delivered some pretty fascinating surprises, I thought. Gave us a real glimpse into a company that seems to be in the middle of a big strategic transformation.
Exactly. Yeah, we're going to unpack how Dragonfly Energy is navigating what's, well, a pretty complex market. Look at their strategic shifts and, what these results really tell us about their potential path forward. Think of it like peeling back the layers, right? To understand not just what happened, but why it matters for their future.
Okay, good. Let's get straight to the chase then and hit the numbers first. Dragonfly Energy reported financial results for Q2 2025 that, well, they certainly caught the market's attention, and for good reason.
Absolutely. So the company posted GAAP EPS, that's their earnings per share, using standard accounting rules of -$0.58. Now, okay, that's still a loss, but it significantly beat the analyst consensus, which was way down at -$1.29.
Big beat there.
Yeah. And their revenue also impressed. It came in at $16.2 million. Again, surpassing the consensus estimate of about $14.68 million. And this represents a pretty robust 23% year-over-year revenue increase. So, better on both the top and bottom lines than expected.
Okay, and looking at that revenue mix, what really drove the growth? Was it just a general rising tide, or was there something more specific going on?
This is where it gets really interesting. The standout performer was undoubtedly their original equipment manufacturer segment, the OEM segment.
Correct.
So think of these as the factory-installed systems, right? Batteries going directly into new RVs or heavy-duty trucks right off the assembly line.
Got it.
Net sales in that segment surged by over 50% year-over-year. 50% to $10.1 million.
Wow.
Yeah, so this shows a really clear acceleration towards these crucial factory integrations. Now, their direct-to-consumer, the DTC sales, which are more sensitive to consumer spending, they did see a 9% year-over-year decline, down to $5.9 million. So that reflects some of that continued macroeconomic caution we're seeing. But the OEM strength more than made up for it. And they also recognized a small $0.25 million licensing fee.
So that OEM jump really carried the quarter.
It did. And it signals, I think, a fundamental de-risking of their business model, too.
De-risking, you say. Can you unpack that a bit? Why is that OEM pivot such a big deal for a company like Dragonfly? I mean, beyond just the revenue numbers themselves.
Well, it's really a foundational shift. They're moving towards a much stickier and more scalable business model. See, OEM sales typically mean larger contracts, more predictable revenue streams, and lower customer acquisition costs, right? Because the product is already integrated into the vehicle from the start.
Right, it's baked in.
Exactly. And it insulates them much more from the whims of, consumer discretionary spending cycles. They're becoming an embedded, almost indispensable technology provider rather than just a retail seller. It's all about building these long-term, high-volume relationships that are just harder for competitors to disrupt.
That makes perfect sense. So with that strong top-line performance and that strategic shift underway, how did profitability look? Because for a growth company, tightening up the bottom line is often, well, the next big hurdle, isn't it?
It is. And profitability saw a significant improvement.
Yeah.
Really significant. Gross margin expanded impressively by 430 basis points.
430, so 4.3 percentage points.
Exactly. A substantial jump year over year, bringing it to 28.3%. And this led to a 45% increase in gross profit. That's up to $4.6 million.
Nice.
And operating expenses were also notably down. They came in at $7.9 million, down from $9.9 million in the prior year. So this translates into a net loss of -$7.2 million. Still a loss, but a huge improvement from -$13.6 million last year.
Big step in the right direction.
Definitely. And adjusted EBITDA, which, many see as a cleaner look at core operational cash flow, that also narrowed considerably. It improved from -$6.2 million to -$2.2 million.
Okay, those are some pretty impressive improvements on the cost side. What's the secret sauce there? What drove those better numbers?
Management pointed to a few key things. First, lower inventory costs. And second, better absorption of fixed costs, mainly due to that increased volume we talked about. This really highlights their operating leverage as sales scale up. The factory gets more efficient.
Right, spreading those fixed costs.
Exactly. And their corporate optimization program also played a significant role. They've been actively reducing operating expenses and, crucially, reallocating resources towards revenue-generating opportunities. Basically streamlining the whole operation. It's like they've done a financial spring cleaning.
Okay. Now, this next point about capital structure. I know it's often overlooked by maybe casual investors, but it can be absolutely critical for a company's long-term health. What did Dragonfly do here, and why is it such a significant move?
Yeah, this is really important stuff. They made truly meaningful progress in simplifying and strengthening their balance sheet, which is, like you said, a big deal for their future flexibility. So in late July, they completed a $5.5 million public offering of common stock. And management made a point of emphasizing this was a straight common stock offering without warrants.
Okay, why is the without warrants part key?
Well, it's a signal, because past offerings often needed warrants attached to kind of sweeten the deal for investors. A straight common offering suggests increased investor confidence. It means people are buying the stock outright without needing those extra incentives. It's a huge vote of confidence, really.
So they didn't have to give away quite as much potential future upside in the deal, effectively.
Precisely. Then, in early August, they took another crucial step. They exchanged all their remaining preferred shares for common stock.
Cleaning up the structure.
It's huge cleanup. This eliminates those associated interest payments that come with preferred shares. And it removes the threat of future share dilution from those preferred shares converting down the line. It significantly cleans up their capital stack, enhances financial flexibility, just lets them focus on growth without that overhang. It's a real strengthening of their foundation.
Right. And we heard a lot about this strategic pivot to OEMs. Can you give us a clearer sense of what that looks like in practice? It sounds like it's more than just selling a battery. It's about integrating deep into their customers' products.
That's exactly right. Their core strategy is fundamentally shifting away from being retail heavy, moving towards these deeper OEM integrations, especially within RVs and heavy-duty trucking. And a prime example, one that really stood out on the call, is their partnership with Airstream.
Oh, yeah, the silver bullets.
The iconic Airstream, yeah. Dragonfly Energy's fully integrated energy storage system. It's slated to become a standard option on select 2026 Airstream models. And this isn't just, selling them batteries off the shelf. It showcases their ability to deliver complete, tailored energy storage solutions. Solutions that fit seamlessly into complex, often space-constrained environments like an RV. It's about being the energy system.
Becoming part of the product spec.
Exactly. And they're also seeing accelerated adoption of their Dragonfly Intelligence smart battery platform. They mentioned several OEMs are currently beta testing it for their 2026 model year lineups. So this indicates a growing appetite for their technology that goes beyond just the battery itself into smart energy management.
Okay. And it sounds like innovation is also a key part of their story, especially with that mention of advanced battery technology. What's the latest on that front, and why is it important long term?
Yeah, innovation is definitely a critical long-term driver for them. They got a new patent granted recently, which is a pretty significant step forward for their non-flammable, all-solid-state battery program.
Solid state, okay? The holy grail for batteries, some say.
Well, it holds a lot of promise. And this patent specifically relates to how they prepare the feedstock for the solid-state electrolytes. To simplify it, think of it as perfecting the recipe for the core material that makes these advanced batteries work. And it's crucial for their dry electrode process.
Dry electrode, what's the advantage there?
It's a manufacturing method that avoids using toxic solvents, so it makes production potentially cheaper, faster, and importantly, more environmentally friendly. This really reinforces their leadership position, or at least their potential leadership, in advanced battery tech. And it suggests a long-term strategic advantage that could unlock substantial value down the road, especially in markets where safety and cost are absolutely paramount.
So if this solid-state tech is truly a potential game changer, when do we see this translate into actual products or revenue? Is this something we should be expecting in the next couple of years, or is it more of a, decade-long play?
Solid-state battery development is definitely more of a longer-term play, no question. But these patents are crucial steps along the way. They prove the technology is advancing, and they secure the intellectual property. It positions them potentially years ahead in what's still a very nascent, but yes, potentially explosive market. So while the immediate impact on revenue is minimal, it absolutely underpins their long-term growth narrative. And it signals to potential partners or customers that, hey, these guys are at the cutting edge of battery innovation.
Got it. So a lot going on strategically. With all these shifts and improvements, what does this all mean for the immediate next quarter? What's their guidance look like for Q3 2025?
Okay, so for the third quarter, Dragonfly Energy anticipates net sales of approximately $15.9 million and adjusted EBITDA of about negative $2.7 million. Now, while that net sales guidance represents roughly 25% year-over-year growth, it is notably below the street's consensus revenue estimate, which was around $17.4 million.
A bit light versus expectations then.
A bit light, yeah. Management did note that Q3 is typically seasonally slower than Q2 for them. That's important context. But they do expect sequential revenue improvement heading into Q4 2025, driven by, they say, continued RV industry improvement and contributions starting to trickle in from new markets. So yeah, maybe a bit of seasonality causing a near-term dip, but the underlying trend they're projecting is still upward.
Okay, let's connect this to the bigger picture now. We heard about heavy-duty trucking pilot programs. That's a segment with just massive potential, right? Anti-idling, cost savings. But it feels like we've been waiting for it to really kick in for a little while now. When can investors realistically expect that segment to contribute meaningfully to the P&L?
You're absolutely right to highlight the anticipation around heavy-duty trucking. It's huge potential. And while these pilot programs are apparently showing very positive feedback, delivering measurable idle reduction, real cost savings for the fleets, management was pretty clear. Significant P&L impact from heavy-duty trucking is not expected until the first half of 2026.
First half of 26. Okay, so still a ways out. Why the delay?
It seems to be largely due to external factors. Primarily, fleets are holding off on new truck orders, partly because of tariff increases that got pushed through by the big truck OEMs and just general uncertainty in the freight market right now. However, and this is important, a ramp-up of pilot systems is anticipated in Q3 and Q4 of this year. So that's a good sign for future adoption. It really feels like a matter of when, not if, those larger orders start flowing.
Got it. So the groundwork is being laid now. Tariffs were also discussed on the call. That can be a real headache for companies with international supply chains. How is Dragonfly managing that potentially volatile environment?
Yeah, tariffs are always tricky. Management stated they've been able to manage the impacts pretty effectively, actually, through a number of mechanisms. Things like negotiating better inventory pricing, which, as we saw, actually helped their margins.
Right.
Passing some costs through to customers where possible. And you're using things like bonded warehousing to spread out payments, which helps with cash flow. But crucially, their domestic manufacturing capabilities in Nevada, where the final assembly is done, provide a real strategic advantage here.
Ah, the U.S. manufacturing angle.
Exactly. This allows them much greater control over quality, cost, production timelines. And it significantly reduces their reliance on overseas production for the final product. They mentioned they can largely onshore most of the components if needed. That's a very strong position to be in, gives them resilience. And if we connect this to the broader industry for a second, the RV market, which is still a core segment for them, it is expected to tick up slightly in 2025 from its 2024 trough. So that's a positive sign after some tough headwinds. And there's also been, interestingly, firmer sentiment around lithium lately due to supply headlines like mine shutdowns and things. Though, long-term lithium pricing still presents a bit of a concern for some analysts looking further out.
Okay, so this raises an important question then. The Q3 guidance was below consensus, which 9 times out of 10 sends shares tumbling. Yet you said the market reaction was very positive. What's the bear case here that maybe investors are overlooking? Or why did the market reward them despite that softer near-term outlook?
It's a great question, and I think it really speaks to what investors are prioritizing right now with this company. Despite that conservative Q3 guidance, the market reaction was, very positive. Shares saw a significant jump of 16.5% following the call, and trading volume surged by, I think it was 234%. Huge volume.
Wow, okay, so investors bought the story.
It certainly looks that way. It suggests investors are really rewarding the strong Q2 execution, that balance sheet cleanup we talked about, and the clear momentum they're building in the OEM segment. They seem to be valuing these fundamental improvements and the strategic shifts over the cautious near-term outlook, which they probably see as just temporary seasonality, like management indicated. So the overall sentiment, as we'd assess it, is kind of cautiously bullish. Analysts seem to agree, holding a moderate buy consensus rating with an average price target around $1.50 or so.
So investors are basically saying, okay, we see the strategic long-term play here, and that outweighs a slightly softer next quarter. Makes sense. For listeners thinking about this company then, what are the key catalysts to monitor going forward? What should you really be watching for that could move the needle one way or the other?
Okay, key things to watch. Definitely incremental OEM design-ins and standardizations, particularly in RVs, obviously, but also keep a close eye on Class 8 heavy-duty trucking. These spec wins are compounding, right? Each new win brings more predictable, higher volume business down the line.
So more Airstream type deals.
Exactly. Also keep an eye on any updates regarding licensing agreements. And on the innovation front, Definitely watch for progress on their manufacturing advancements in that whole dry electrode roadmap for solid-state batteries. And finally, observe whether those margin gains hold up as the product mix shifts further towards OEM sales. And if their working capital intensity starts to ease as they gain more scale, those will be really crucial indicators of sustained operational success and their ability to execute this whole transformation.
All right, perfect. It's time for our This Is Not Financial Advice segment. This is where we pitch some, let's say, outrageous but plausible trade ideas, just like we're in a no-holds-barred investment committee meeting. All right, hit us with your thinking on Dragonfly Energy. Let's get a little creative here.
Okay, outrageous but plausible. Given that compelling OEM pivot and the really significant balance sheet cleanup, my first idea is, maybe for the long-term believers out there, a bold, direct, long position in Dragonfly Energy. The market is clearly rewarding their operational execution and that strategic shift away from being so retail heavy. That Airstream win is a clear signal of deeper integration potential. And that new solid-state battery patent, while long-term, it hints at significant value that might be currently overlooked by the market. The perceived risk from the softer Q3 guidance feels like it might already be priced in after that pop. So maybe it offers an attractive entry point for those betting on the full turnaround narrative playing out. To bet on a corporate glow-up, basically.
Bold indeed, a classic buy the dip and believe in the transformation play. Any other thoughts on how to play this, maybe for those with a slightly longer time horizon or perhaps a different risk appetite?
Okay, second idea takes a longer, maybe more nuanced view, specifically acknowledging that delayed impact from heavy-duty trucking. What about considering a long-dated, out-of-the-money call spread, maybe expiring mid-2026? This specifically trades on the catalyst of significant revenue finally coming through from that heavy-duty trucking segment, which again, management explicitly stated isn't really expected until the first half of next year, 2026.
So timing the trucking ramp up.
Exactly. You'd be betting on the when, not if, for heavy-duty trucking adoption. You acknowledge the near-term delays, but you leverage the potential for a really substantial jump once those new truck orders finally materialize and their systems get properly spec'd in across fleets. It's a play on future operational leverage manifesting itself, offers defined risk with potentially substantial upside. If the trucking segment finally delivers on its long-awaited promise, it's definitely for those who'd like to play the longer game.
Interesting. Two different ways to look at it. Okay, so to recap our deep dive into Dragonfly Energy, we saw a strong Q2 beat, really driven by that impressive OEM growth, significant improvements in profitability, and importantly, their capital structure, and a very clear strategic pivot towards integrated solutions that seems to be fundamentally de-risking the business.
Yeah, and while the near-term guidance shows some seasonality, maybe a little softness, the company really does seem to be laying a robust foundation. They've got domestic manufacturing advantages, cutting-edge innovation in advanced battery technology, all positioning themselves, it seems, for sustained growth, particularly in those key OEM and heavy-duty trucking markets. So the question for you listening is, do you believe their transformation will continue to accelerate, or there's still maybe too much road ahead, too much uncertainty?
And as always, please remember that everything discussed on this deep dive is for informational purposes only. It is absolutely not financial advice. We strongly encourage you to do your own research and consult with a qualified financial professional before making any investment decisions.
Yeah, we hope this deep dive gave you some valuable insights into Dragonfly Energy's pretty fascinating journey right now. What stood out to you? We'd love to hear your thoughts, and we look forward to bringing you more in-depth analysis next time.
Thanks for tuning in to the deep dive.